All right. Thank you, everybody, for taking the time to be with us here today. We're very excited to have Mark with us. Mark Halpern is a certified financial planner, a trust and estate practitioner, and widely recognized as one of Canada's top life insurance advisors. As CEO of wealthinsurance.com and illnessprotection.com, Mark leads a team across Canada that provides special expertise and insurance strategies for business owners, entrepreneurs, professionals, and wealthy families. Mark works closely with lawyers, accountants, bankers, and financial advisors to provide their clients with unique insurance products and comprehensive estate planning solutions. He regularly contributes articles to the Tax Letter and is frequently quoted in national media and financial industry publications. At the end of this presentation, we will have time for a question and answer period. So if throughout the course of the webinar you have any questions, please type them into the chat box and we'll address them at the end. So without further ado, I'll let Mark take it away.
Thank you, Shelby. Good afternoon, everybody. So nice to be on the call today. It's actually been a great day so far, this being one of the highlights. But earlier in the day, there was a great article that appeared in the Globe and Mail, and there's a link to it in the chats that you can go to on the case of Aretha Franklin not having a will and a huge estate. And there's some great resource material there for ourselves and for our clients. And I think it's something you should take a look at. And the other nice highlight today was I've taken on the role as a vice chair of a $1 billion foundation, a public foundation. So I've been on the professional advisory committee for a number of years, and they made the announcement today. So that's exciting because it really ties into a lot about what we're going to be speaking about today. Just as a background, I have been specializing in the area of estate planning, but really being an insurance specialist professionally for 27 years. But my real start was 45 years ago, and that's when my father of blessed memory died of a massive heart attack at the age of 50. I was 11 and I was the youngest of four boys, and my mother, who was 48 at the time, had to go back to work to support our family. Problem was my father was a busy engineer, and unfortunately there wasn't a will, there was very little savings, and there was no life insurance. So I know how difficult that was for us. But fast forward, I spend my time dealing with wealthy business owners and entrepreneurs and families who could be worth tens of millions, hundreds of millions of dollars. And as we would all appreciate, we think that they've got everything together. But I would suggest 80% of the time that's not true. They're so busy looking after their staff and their suppliers and their contractors. And when it comes to themselves, they're really all offense and really lacking in the area of defense. So our job is really on the defense side. And it's kind of, we take a 30,000-foot look at helping people with either a first or second estate planning checklist, where we, crash test their lives and create a list of all the things they need to do and help them prioritize those, help them get the help of either their professional advisors or people that they might want to be introduced to in order to get these incompletions done. So that's the first part of what we do. The second part of what we do is really tax. We've never been in a period of time where there's more tax than there is right now. And our clients are looking for ways to keep their taxes for themselves and their families or for charities they might be passionate about. So we use tax-exempt insurance strategies to help them accumulate their money on a tax-exempt basis and access it on a tax-exempt basis and pass it along by, if they're a business owner, going from taxable dividends to creating tax-free capital dividends. And we'll talk about that later as well. And then the last part of our business is really philanthropy, which is a big part of our conversation today, which is helping people to convert their tax dollars that they'd have to pay into charitable dollars. And people are looking to create legacies and values as we'll go along in this presentation. So that's really our business. And today we're just going to focus on some changes around insurance and tax and philanthropy. And hopefully you'll learn something. And at the end of it, there'll certainly be time for questions along the way as well. So the first thing, next, it seems to be that, again, just a disclaimer, I don't have to tell you, you're all professionals. But if you go back, it seems like in 2003, a lot's changed. We had Steve Jobs, Bob Hope, and Johnny Cash. And then 15 years later, unfortunately, no jobs, no hope, and no cash. The good news is it's not all doom and gloom. There have been a lot of changes in Ottawa as far as Revenue Canada next, and you'll see that to help us with all these changes, the government's going to issue a new one-page simplified tax return, and it's going to have one question: how much did you make? Send it to us. Of course, this is all tongue-in-cheek. It's almost like that, though. Next. The agenda today is really looking at planning versus investing. We're going to talk about some passive income strategies and how we can help clients. We'll touch on immediate financing arrangements as well as a strategy. And then, of course, it's really all about creating some sort of strategic philanthropy, and we'll go from there. The big changes, I think, are coming, and I like to share this with every professional and with every prospect and client. The biggest thing is that the government's not going to be capable of taking care of the elderly in this country. That's not a political statement. It's a math problem. The baby boomers started turning 65 in the year 2011. It's going to affect a lot of things that we take for granted. They say that the industrial world's going to start looking more like Century Village in Florida. You'll see people needing money, getting it out of the markets. And, we've had some volatility in the markets, but you just look at the late 80s when a third of the Japanese population retired en masse, and their index went from 40,000 to 7,000. It still hasn't recovered to 25% of what it once was. You also see people downsizing in terms of real estate. Who's going to buy all this real estate? And then, of course, the real issue is in healthcare. The system is already, we've got a great country, but the system is already being fully utilized. And imagine now when older people are using it, what we're going to do. So people definitely need to take some responsibility in that area. The second big change is with modern technology, people are living longer. So there's a good chance that people might be long on life and short on money, with a false expectation that there's going to be a big wealth transfer from their parents, the greatest saving generation of all time, to them, the greatest spending generation of all time. So people have to appreciate that. I think the statistic said that 50% of all babies born today will live past 100. So some of our expectations in terms of retirement and outliving money have to be altered. And then the third big change is we've gone from an industrial age to an information age, or I like to call it a misinformation age. It seems like everybody's going online and using Google, but you can't replace professional advice. And as a result, it's so much more incumbent on us to be able to provide the information that our clients need on a timely basis. We've all heard of Freedom 55. It's a famous expression from London Life. They say that today, Freedom 55 is when your youngest child will be 55. And that's kind of, there's not a lot of joke in that. This is the first generation where our children are not expected to exceed the success of the parents. Just think of living in the GTA or Vancouver with real estate. Like, how do people afford that? And finally, we are really the gatekeepers to thousands and thousands of clients. So what we're going to talk about today certainly is stuff that we have to be able to address to them in a timely fashion and provide them resources they need in order to protect their families. Next. Here's just a big picture of the planning that we do. Clearly, it's, our clients, and you do a lot of this as well, but it's really making sure that, people have things in place. Like I like to look at it as, when our clients started their businesses and their families, they had a type of financial architecture, and they put furniture in that reflected that financial architecture. Fast forward, the financial architecture looks completely different. The question is, does the furniture still fit in with that financial architecture? So we look at things from 30,000 feet up. As I said, most people don't have a will. If they do, it's not up to date. It was done by a generalist versus a specialist. It doesn't take into account any probate tax planning, et cetera. I think these are very important things, in terms of, setting things up for creditor protection and protection against litigation. Just even having a list in the estate directory of where is everything located. We've created a whole resource of writable PDFs that are available at our website, and we're very happy to give those to you. But there is a writable PDF for an estate directory and an executor duties checklist and a business succession guide. These are things that are very important. And as you can see, we go through a whole slew of things, finally getting to charitable plan giving with each of our clients, and we'll talk more about that as we go along. And taxes, why do we need to look at this? Because, as I said, we've never been in a situation where it seems to be that the government's getting to keep more than we are. In Canada, as we're going to see, if you have a lot of Canadians have money in their registered assets, and there's going to be a disposition of 54% on the second to die of a husband and wife. So they can have $1 million, but only $460,000 is going to their family. If anything, the government is biased, even more so against widows, divorcees, and singles, because they're one event away from a huge tax disposition, and we'll talk about that later. Capital gains other than principal real estate, investment properties, shares in company shares or marketable securities, 26% of the gains. Passive income right now is at Ontario 50.17%. So if you make $1, you get to keep 49 cents and give away the other 50 cents. And then corporate holdings, people are sitting there with money in investcos, holdcos, and the possibility of tax of at least 45% or more, and a possible double taxation on the sale of shares and assets. And then we got probate for 1.5% in Ontario. So as you can see, somebody can be sitting there with $50 million of net worth, but when we do the work and show them that only $35 million is going to be going to their family, it seems to get their attention to want to talk about these things. Shelby, next. And why is that? Taxes are payable on pretty much everything. Here's just an egg carton. I'm still surprised, as I'm sure you are, in the accounting profession, and how many of our clients don't realize there's taxes on selling or on their RSPs or on art or on their risks or any sort of collectibles or business assets. And I've had some people wake up to that as we go through this process, and I think the key is to let them know about these things today while the sun is shining so that they can plan accordingly, as opposed to not knowing about this when their options would be much less. Next. So why is it that people need to be concerned? Here's just a very crude example of somebody investing $1 million in a non-registered portfolio. Let's say they put it into a GIC at 4%. Good luck if you could get 4%. And they just put that $1 million away at 4% compounded for 25 years. If they were at a utopia where there was no tax, their family would get about $2.5 million or close to $3 million. But because of the high tax on fixed income, the family only gets $1.5 million, which means their cumulative loss to tax was $1 million. Notice that they've lost more to tax than their original investment. So clearly, if they've got money, call it never spend money or whatever, there are ways for them to be able to shelter that money, and in which case get a much better return for their family or for charity. Next. I think it really starts with a conversation, and this is very important because I meet people who have brokers, and as sure you do as well, but they do investing. They don't do planning. And certainly the people at Wealth Stewards are very familiar with this, and how important planning is. But this is just an illustration of somebody who grows their assets, and then at some point in time, they're going to start accessing that money, perhaps to supplement their retirement plans. But if they're really good investors, could be that their estate's actually going to be continuing to increase or at least level off. But the bottom line is, if they've done the work to make sure that they get a check mark that they're never going to run out of their money based on a whole bunch of assumptions, it will also help us understand what their tax situation is now and down the road. But at the same time, they'll also find out that likely they've passed this point in their career where, unless they were to blow their money on some penny stock or spend it on something crazy, they're likely going to have more money when they die than when they live. So while they're the custodian or trustee for that money for the next generation, unfortunately, they're also partnering with Revenue Canada on that money. So we need to show them that there are ways to be able to use some of that money to preserve their estate or provide money for charity where it doesn't impact their lifestyle at all. And that, I think, is a very important thing that Wealth Stewards does, and that we really subscribe to, that our clients have to do that type of planning in order to be able to get to the next step. Next. And what's happened, we just have a lot of things going on in Ottawa. Everyone's talking about the TOSI rules, the tax on split income. I mean, unfortunately, we all set up, OpCo, HoldCos, family trust, and we're giving out these wonderful dividends to our family members over age 18. Well, that's changed. Certainly, there are ways around it, and that requires, knowledge and telling our clients clearly. But one of the things on the TOSI that people are not necessarily aware of is being able to multiply the lifetime capital gains exemption with family members is still there with estate freezes, and I think that's something that is still very valuable and has to be discussed. But everyone's talking about passive income. It was enacted in June, and it's effective January 1st, 2019. And we're all aware of the fact that a business owner now can have $50,000 of passive income, and anything over $50,000, he's going to be penalized $5 per dollar to reduce the capital gains rates. So possibility of going from 13.5% to 26.5%. So in a nutshell, you're talking about they're going after the 1%ers. That's the government. They say the 1%ers. Unfortunately, the 1%ers are people making $220,000, which is really not a lot of money, especially if you're paying tax at 53%. And that's not exceptional. In the U.S., they're going after billionaires. But it does mean that somebody can be stuck in a situation where they might be paying now additional taxes of somewhere between $55,000 and $70,000. So here are just some very high, quick level ideas on passive income strategies. Certainly looking at things like corporate class mutual funds where it's really a return of capital. So for instance, the income might be 2%, but the return of capital is 6%. So that might be something that they can look at. Certainly retirement compensation arrangements, they're part of the Tax Act. They don't have the same oomph in terms of the benefits that they used to, but that's certainly something to look at. Anybody who's a professional athlete, hockey player, basketball, tennis, soccer, football, RCAs are a fantastic thing for them. They should definitely be looking at it, especially since they're likely to live in a different jurisdiction when they retire. Individual pension plans are really in vogue right now, and they've been around for a long time, but they allow your company to go ahead and write a big check as a deduction, and it's not a taxable benefit to the shareholder. And it basically looks like about a 65% lift in terms of what they're doing on RSPs right now. And because of the fact that it is a registered pension, there's a certain expectation of return. In this case, it's 7%. So if your fund doesn't, perform on that basis, the company can write another check to bump it up. So that's one thing that's, I think, very important to get an illustration for your clients and look at that. If you have any clients who have family members who are in the business, so then that's a great way also where instead of your RSP or RIF being taxable on the second to die of a husband and wife, by having an IPP and having other children in the business, it's a way of continuing to have that money still be in the family. Investing in public companies with low dividend rates, that could be like companies like Fairfax. I'm not recommending it, but at $600 a share, their dividend is like $10 or 2% or something. Avoiding association of corporations. Clearly, you have to look at all the corporations, their passive income. Trust can cause an association, so really you have to look at the tax side. And there are going to be people increasing owner-manager dividend salaries and talking about charitable giving as we go. But the last area, which still has passed the litmus test, is the use of tax-exempt permanent life insurance. I like to look at tax-exempt permanent life insurance. If you want to look as an analogy, if your clients likely have a TFSA, which most people will have, and the reason they like the TFSA is because your money goes tax-free. The downside of a TFSA is you can only put in $5,500 a year, which is going to be increasing to $6,000 based on the announcements recently. So we like to show clients that they could have a corporate TFSA or a personal TFSA without a ceiling, where they could put money into it where it grows tax-free, they can access it tax-free and pass it along tax-free. And that's called using either corporate life insurance or personally owned life insurance of a permanent nature. Shelby? And just here, as we mentioned about the corporate-owned life insurance. The other side of it is immediate financing arrangements. This would be for any of your clients who have real estate or private equity or large marketable securities. And at the end of the day, there's going to be a tax. And that tax, as we saw, is going to have to either be paid by a family having cash or having to leverage to borrow against assets to come up to pay that tax, or they're going to have to sell assets. Unfortunately, a lot of the time they have to sell the cottage, or a business have to be sold, or they use life insurance. And life insurance is the least expensive, tax-effective way to do the planning. But even then, our clients go, you know what, I'm making 15-20% of my business or my investments. I don't want to put it into insurance. So that's where immediate financing fits in. You can put money into a policy, use the policy as collateral to borrow the money that you put in, put it back into your business or in your investments. Because you're borrowing to invest, you get to deduct the interest. So now you're just servicing a loan, and you've got the insurance in place for your ultimate estate tax liabilities. And that amount that you borrowed can either be paid back at some time that you've had a disposition on some investments, or 90% of the time you use the life insurance to go ahead and pay that down. The amount that you borrowed, and the rest goes to your family for taxes. And the last thing is shared ownership critical illness insurance. It's just a way, if you have clients who have a concern that something, if they get health, that if their health goes awry, it would have an impact on them financially. It allows a company, an owner-managed company, to purchase a shared policy where the company owns the morbidity benefit, and the shareholder owns the return of premium rider. It works out to about 90% paid by the company, and then the 10% paid for the rider by the sole the owner. What happens if they do get sick, the money goes into the company. It has to come out as a taxable dividend or as salary, or if they have a shareholder loan, clearly it comes out tax-free. Or after 15 years, because they own the return of premium rider, it allows them to extract the money the company paid for the 90% of the critical illness each year, and the 10% that they paid, and it works out to about a 15 to 25% return on their money. Again, it's a bit more aggressive, but it's another way to get money out of passive income. Next. Getting back now to charitable giving, as you can see, we looked at the big picture, and now always we talk about charitable plan giving and how do we help our clients create legacies. So when talking to people about philanthropy or legacies, I look at it as a sandwich. There has to be an emotional component first, and then there has to be the technical component, that's the meat and potatoes inside, and then it's closed again with the emotional part of it. And I'd like to start off a conversation with that. Every one of us, each of us, has three possible beneficiaries to their estate. You have family, you have government, and you've got charity. And each of us can pick two. Which two would you pick? Well, most people are going to take family and charity. So we can show them ways to structure their planning where they're remembered for leaving a big check to charities that they care about, as opposed to a big check to the CRA. And that comes through a planning process. Next. And here are just some very high level of gifting options, and we're just going to touch on them briefly. I think there's a real timing issue here because it is end of year, and some of these things I think you're going to really be very impressed with and inspired to do something. But one is having a will with a bequest, a gift and a will, looking at gifting RSPs or RIFs, looking at gifting marketable securities, and finally looking at gifting life insurance policies. Next. So as far as the bequest, and there's a slide that wasn't here, but as far as the bequest, one way to donate with a bequest is just by changing one's will, where you indicate a certain percentage or dollar amount that's going to charity. Whatever dollar amount or percentage that you're giving to charity is going to be a deduction to your estate. So it's very effective that way. The other way of giving as a bequest is, we mentioned about RSPs being highly taxed, as you can see from this slide. Instead of changing your will, if you just wanted to make a gift, you could go to your financial institution and ask them for a multiple beneficiary form. Yes, the banks have it, and your mutual fund person would have it as well. They just have to dig it up, but it just allows you to have a multiple beneficiary form, in which case you would put down who the beneficiaries are of your RSP or RIF. And of course, whatever you do give to charity will basically negate the taxes that would be owed on that registered money if you took it out. And why is that? Because the RSP or RIF is really a tax time bomb. $1 million is $460. Most wealthy people are taking out the minimum amount. Certainly their accountants are suggesting that as well. So if they're taking out 5% every year, but they're making 8%, they've really got a deferred tax liability on that RIF. So are there things that we could be helping with our clients with to reduce that tax liability and at the same time create money for charity? Next. And here's just one way. Here's a woman we met, age 71. She's a widow. She has $500,000 in a RIF that really she doesn't need the income. It works out to about $20,000 a year net after the withdrawals and taxes. And, you know, she's just reinvesting that money and being taxed on it. So we said, here, you could take that $20,000 and with that you could fund a $500,000 life insurance policy. Again, we're assuming that she's insurable. If she goes ahead and takes that policy now and makes the beneficiary of half of it a charity and half of it her family, so look what happens. The charity gets $250,000. That creates a $250,000 charitable receipt, which would now save the estate about $125,000 of tax. And the kids get $250,000. So what we've done is we've created now $375,000 for the family, where let's say they would only get $230,000, and we've also created $250,000 for charity. And these types of programs are very easy to implement. The charities are very happy to learn about these because what they'll do is they'll recognize somebody today while they're alive for this gift, even though it's something that's going to be coming down the road. I have another client that was referred to us by an investment company where the woman was a widow and she had an $8.2 million RIF. Clearly, the husband had been a good investor in some penny stocks or whatever, and that was worth $8.2 million, which meant over $4 million was going to be going to the government. What we did was she was taking out minimally $500,000 a year, which was $250,000 after tax. We used that $250,000 to purchase a $5 million life insurance policy on her, and we made the beneficiary of that $5 million either a charity, which would generate a $5 million tax receipt, which would save the estate $2.5 million from the $5 million, and the balance of the RIF would still go to the kids. So we basically doubled what the kids would get at the end, and still created a gift for $5 million. And there are different ways to scale that, and different permutations as well. Next. And here, marketable securities. I'm sure that all of us have clients who give charity, and likely if you ask them how they give their charity, or just by looking at their tax return, generally 96% of the population will give by cash. And I just want to publicly say that is the worst way to give money, because you have to go through the tax cycle in order to get to that money to give to charity. So here was a client. It was a lawyer who gave $50,000 a year of cash gifts. And what I explained to him was he had a lot of marketable securities. Let's assume he has some shares for $50,000 of market value with a cost base of $10,000. If you were to sell that $50,000 of stock with a cost base of $10,000, he would have to pay taxes of 25% on the $40,000 gross. So he'd have to pay taxes of 10. So his 50 in this case would only be worth 40. So what we suggested is he start up a donor-advised fund or go to a charity and donate $50,000 in marketable securities. When you do that, he gets the full tax receipt for $50,000, but pays no capital gains tax, none whatsoever. So we save $10,000 in tax. And again, if you set up a donor-advised fund, especially I'm bringing this up right now at the end of the year, I'll just explain. I just had a meeting this morning with a woman who had $200,000 of some cannabis stock, and she's going to have about a $60,000 or $50,000 tax in 2018. I suggested to her, donate $100,000 of the stock. The cost base is $0, so the tax on $100,000 would be $25,000. So she's donating $100,000 to a donor-advised fund. She gets a charitable receipt, doesn't pay the taxes of $25,000 capital gains, And at the end of the day, now she has a charitable receipt for $100,000. That's going to save $50,000 on tax. So we've just wiped out her 2018 taxes. It'll be due in 2019. The timing is very time sensitive. This is an area that, any of our clients who've had any money, non-registered money in the markets for the last 15, 20 years, their money has quadrupled, gone up 5 times. They all have pregnant capital gain stock. So this is a wonderful way to create a lot of charity, save a lot of taxes for our clients in terms of capital gains, and also save them taxes on their income. Next. Finally, there aren't a lot of tax shelters left in Canada other than your principal residence that you bought for $1 million. That goes up to $2 million. You pay no taxes on that. TFSAs are also not taxed. Lottery winnings in Canada are not taxed yet. In the States they are, so make sure if you're going to win the 649, do it here. And then the last thing is tax-exempt life insurance. It's still one of the few true tax-exempt strategies that we have left in Canada. Next. So here's an example of 3 different ways to maximize gifting to charity at a minimum cost. First one is gifting an existing policy. You might have clients who have policies that are part of their portfolio that they don't really need. So I had a client who was 80, who's worth over $100 million. He had like a $125,000 life insurance policy with Sun Life that would not change, it wouldn't move the dial clearly to his wife. But we went to an actuary, and the value on that policy was $85,000. So he was able to donate the policy to charity, get an $85,000 charitable receipt today, so he benefits while he's alive. And then going forward, the premiums that he's paying are now considered charitable donations, so he gets a charitable receipt for that as well. So it was a wonderful way to create a very easy gift, and at the same time be recognized for giving something substantial, which had a great value to him. You'll notice in brackets it says including term insurance. And I bring this up because we had a recent situation with an institution that had a member who wanted to donate a life insurance policy that they had in force already. And the thing is, they didn't want to pay for the premiums going forward. So this person, unfortunately, was not insurable. It wasn't a big policy. It was only a few $100,000. But what we did was we were able to convert it, because you can convert term insurance before age 65 without any medical evidence whatsoever. And then there's an actuarial value on that policy. In this case, the value was, several $100,000. So he was able to donate this policy, get a charitable receipt for several $100,000 to save taxes now. And then going forward, as far as the premiums, the nonprofit was able to find donors who would pay for that policy going forward, either using marketable securities or cash, or using their own funds. So what happens is the organization would recognize both the insured who donates the policy on his life, and he gets a nice benefit of a big tax break, and then the person who's actually funding the policy, they also get recognized, and they don't have to know it's each other, but it's certainly a way to create more goodwill. Other things, gift of a new policy. So if you have a charity in mind and you buy $1 million policy and you want to make the charity the owner and beneficiary of that policy, all your premiums are considered charitable donations, and you get a charitable receipt, which means for really very small cost, you can be recognized as being a very large contributor to an organization you're passionate about, which is wonderful. And the last thing is gifting the insurance on death. So as an example, somebody knows they have an estate tax of $1 million. They could go ahead and get a $2 million life insurance policy as an example, and make the beneficiary of that either their own charitable foundation or to a charity. It would generate a $2 million charitable receipt, which would then in turn eliminate the $1 million of tax that would be owing. So that would be a great way, as we said, to be remembered to give a large amount to charity as opposed to a big check to the CRA. Next. And here's an idea that we created. It's called CPP Philanthropy. It was actually very well recognized. The Globe and Mail put an op-ed piece last November 2017 in the paper. We're happy to share that with you. But we all have clients who at age 65 start collecting CPP. It works out to about $26,000 a year for a husband and wife. It's taxable fully. Generally, they don't need it. If they're wealthy, it gets taxed, they reinvest it, it gets taxed again. So we came up with a strategy that they could use the government CPP, so government funding, to fund their charitable aspirations. And here's how it works. That $26,000 a year could purchase a $1.4 million life insurance policy on a 65-year-old couple. And again, you need at least one of them to be healthy, right? And if the policy is owned right from the get-go by the charity, as we saw, where the charity is the owner and the beneficiary, then the $26,000 of CPP is considered a charitable donation. So now you've negated your tax on CPP, and you're recognized for giving a gift of $1.4 million. Another way might be that, no, I'll take the CPP, I'll pay tax on it, I'll get the $1.4 million policy, but I'll make the beneficiary of the policy a charity, right, as opposed to the charity owning it from the get-go, in which case on death, the charity would get the $1.4 million, create a charitable receipt for $1.4 million, and now save the estate $700,000. So a great win-win. The final one is this. Remember we talked about, let's say, somebody having $2 million in a RIF or an RSP that would only be worth $960,000 to a family on the second to die. Take the CPP, use that CPP money to buy the $1.4 million policy, make your children the beneficiary of the policy, and donate your RSP or RIF to charity. So now what happens is that $2 million of that RIF would go to charity. There'd be no taxes. So, and your kids are getting still $1.4 million, where they would have only have received $960. So you've given them a lift of about 50%, and you've created $2 million for charity or whatever the amount is. Clearly, it's all scalable, but there's a big windfall here for family and charities, and it's just a question of sitting down and having that conversation. Next. Other planning strategies, we talked about foundations or donor advised funds. Look, if people can set up their own private foundation, but clearly there's CRA that gets involved, there's setup fees, there's annual reporting fees, legals, accounting, etc. And I wouldn't recommend somebody does that unless they have, let's say, at least $10 million in charity for their foundation. The other way is you can work with a public foundation. There are public foundations like the Toronto Foundation, Oakville Foundation, Barrie Foundation, Vancouver Foundation, the Jewish Foundation. There are all these foundations that you can actually use their public foundation and have your own private foundation called a donor advised fund within it. This is that woman this morning that I was mentioning about giving the $100,000 of stock. We're sending a donor advised fund. So she has one place where she gives her charity. She gets one receipt and doesn't have to go looking around for receipts during the end of the year. And she now has a concierge that she sends an email to distribute that money. The minimum is $100 that can go to any registered charity in Canada. And that's really nice also, as we said, at the end of the tax year, where you could be making a contribution of shares. You don't necessarily have to have the money go out right away. It could be a flow through to any charities you want, or you can set it up as an endowment where a minimum of 4% has to go out to charities. And that money that you leave on the table in your donor advised fund is invested by the foundation. I know the returns last year with the one that I'm involved with was 11.1%. So if somebody had $100,000 in their donor advised fund, the next year they had $111,000. So it's just a great way. The last thing on donor advised funds is if you have a private foundation, you can go into the CRA website and see everybody's private foundation. So you'll see how much is in it, who the directors are, and where the money goes to. Whereas if you work with a public foundation and have a donor advised fund, it's completely private. So just thought I'd tell you that. Flow-through shares, certainly they're available. Pear Tree, Bear Tove, Sprott, there are a number of different ones. Just a way, if somebody's already charitable, it's a way to give charity at the least cost possible. Challenge sometimes with this is just timing at the end of the year and finding product available to use for flow-throughs. Leveraged philanthropy is just a way for people who are charitable and still have a healthy place to invest their money to create a very large gift using insurance and leverage, where they put money into a policy and then they leverage the money back out, put it back into their investments, and have deduct the interest and have the death benefit paid to a charity at some point in the future, which would create a huge charitable receipt to pay off outstanding estate taxes. So it's a great way of kind of having your cake and eating it too. Corporate insured double dip. I think this is very important. If you have any clients who are selling their business or have marketable securities inside of their business, it's a much more, you can maximize your giving by doing it corporately versus personally. With personal, you can only use up to 75% of your income in terms of deductions, and then it's about 50% that you get back. If you donate stock, let's say corporately, it's a 100% deduction to the corporation, which is great, reduces the cost of the value of the company. But the other benefit is that you have a credit of whatever the capital gain is in that stock to the CDA, to the capital dividend account. And now the shareholder can pull that money out tax-free from the capital dividend account. So that's wonderful. If it's the year in which case they sell their business, that is the 1 year that they can make their biggest contribution to charity and reduce their taxes. So utilizing that same strategy, they could write a big check to a charity, get a huge deduction that they can use, and then utilizing that CDA tax benefit, they could then use that to purchase, let's say, life insurance to make their family whole. So in other words, the money would come back to them at some point, at a point in time in the future. So now they've given a great big gift to charity, they've saved a whole bunch of taxes, and their family's going to get back that money through the use of insurance. So definitely, it's not a cookie cutter. Every situation is different. We'd have to sit down and talk about it. Charitable insured annuity is another great way for clients that we have to get a return on their money. And there's a tax benefit because they get to deduct, they get a nice charitable receipt now. And it also is a way of ensuring that people can continue giving what they've been giving in the past to charities they care about. And then charitable remainder trusts, again, a way to get a benefit while you're alive for tax purposes and be able to pass along assets after you're no longer around. But not as popular, but still one of the planning ideas. Next. So we'll finish just with the last couple of things here, some case studies, just to give you an idea of where the charity fits in here. The first one was a cardiologist that we met, and after doing a bunch of planning for him, we realized he had too much insurance. So he was a single guy, and even though he had a professional corporation, he sort of saw that he didn't need all that insurance. So he said, let's cancel the policy. And I said, Jonathan, instead of canceling the policy, I know you're charitable, and I know that you're going to have some taxes because of the fact that you're single. Why don't we donate the policy instead? So he didn't understand how that worked. And what we did was we set up a donor advised fund where he has 4 beneficiaries to this $1 million policy, including South Lake Hospital, Mackenzie Health, McGill Medical School, and a welfare fund. And listen what happened. South Lake Hospital featured him in a 2-page spread called, The Cardiologist with Heart. Happy to send it to you. It was great when it came out. I wondered where my name was. But he's been a great ambassador. And also one of the foundations recognized him in their book of life as a generous philanthropist. So he went from let's cancel this policy to suddenly being a philanthropist on a very, very shoestring cost to him. So don't, all we have to do is look around for opportunities like this. Met a guy who was in his 70s, been divorced for over 30 years, had a RIF of about $2.2 million. When I told him half that money was going to be going to the government, I can't tell you how many bad words came out of his mouth, but he was not aware of it, as most people aren't. So what we did was we said, here, he had $120,000 of income that he had to take out. He didn't need the money. He had a big pension, and he also was still working. So we set up a donor advised fund where $68,000 of the $120,000 would go to for current gifts. And again, that negated the tax on $60,000. And then the other $60,000, we bought a $2 million life insurance policy that was also owned by his donor advised fund, which also created a charitable receipt for $60,000. So we negated the $120,000 and multiplied his gifting. Again, it was a great way to, and he was also recognized in the Book of Life and had all of his kids and grandchildren at that event, and it was great. An individual who had a commitment, the socialite, to some universities and hospitals, and she had wanted to know how was the most efficient way to do it. So what we did was we set up $1 million life insurance policy. It was a 10-pay. So it's $25,000 a year. She was younger, but $25,000 a year, it would be paid for 10 years. And we made the beneficiary of that policy all the different charities that she cared about. So that would be great, but what I did was I spoke to the investment person and asked her whether she had any, appreciated marketable securities. So she did. She had a whole bunch of stocks. So we donated $25,000 of stock to be used to pay for her policy. So she had no capital gain. She got the full charitable receipt for the donation, and we were able to use that to fund the policy. And as a result, all the charities that she gave as beneficiaries were extremely appreciative and recognized her. And finally, the young entrepreneur. Like I look at when somebody gives charity, there are a few different types. One person gives charity, they want to be as below the radar as possible. They don't want any acknowledgement, their name nowhere, very into privacy. Others like to give because they want to encourage other people to give, which is a great thing, or they like the idea of having their name on a building or an endowment or a chair or something. It's great for their family and legacies. Or they see philanthropy advantages around building their business. So it's a great way to meet other wealthy people and philanthropists. So here was a young entrepreneur that I was mentoring, and I told him to purchase $1 million life insurance policy on him and his wife. They're in their 30s, early 30s. So the cost at 20 years they pay for was only $5,500 a year, very small amount. And what we did was they donated the policy to a large hospital in southwestern Ontario. And the $5,500 is considered a charitable donation. So it's only costing him $2,750 to be $1 million giver to a big institution, which of course they were so happy to receive. As a result of that, he's now the co-chair of the Young President's Council. And you can only imagine that he is associating with other philanthropists and wealthy people and people who are very passionate. And that's a great way to meet people because those are the types of people we clearly want to help, people who are committed and love their families and love charities. And it was a great way for him to achieve some fame in that area and build his brand. So a lot of our clients have they do their charity on sort of an ad hoc basis. I believe that there is a strategic philanthropy that business owners have to look at that would engage their ownership, their staff, their suppliers, and their clients as well. Next. So we talked about the emotion, the technical, and we end with the emotional. And I ask clients, do you know the names of your grandparents? Most people will say they know the names of their grandparents. But then you can ask them, do you know the names of your great-grandparents? And most people, 90% of the population, does not know the names of their great-grandparents. This is actually a picture of my great-grandparents in 1934 in Poland, before they were killed in the Holocaust. But imagine if on January the 1st, you received an envelope in the mail, and inside that envelope was a check for $10,000 from your great-grandfather. Do you think you'd remember their name? Chances are you would. So there's a way with planning, with proper estate planning, to be able to create legacies for children, grandchildren, for many, many generations going forward. And why is this important? Because our clients have been so busy working on success, building success, but at some point in time, they transfer from this area of success to significance. And we want to help them create significant lives. We all can help them with that. And they say that the apple doesn't fall far from the tree. That's when the weather conditions are absolutely perfect. But if it's a little windy, the apple's further from the tree. And if you've got a hurricane or a tsunami, the apple doesn't even know that it came from a tree or what the tree looked like. And unfortunately, we're living in times today where, it's a busier world. Our kids are so into technology. Friendships, relationships have changed so much. I say that there are two ways for families to stay whole when it comes to legacies and values. One way, of course, is religion, and the other way is philanthropy. Philanthropy is just a way to get children and grandchildren involved and engaged. And there are a whole bunch of strategies we help them create to engage those people in that process. So I think it's just really a matter of sitting down and having the conversation to see how they can be helped. Next. So as far as next steps, I always have something called a 48-hour rule. That is, if we don't act on something we've been inspired by or or been educated about within 48 hours. Often it gets lost and sort of ends up on that, that corkboard with the, the things to do list. What we are offering through our association with Wealth Stewards and all the great work they're doing is certainly you should contact Wealth Stewards. We'd be very happy and open to providing a no obligation first or second opinion on the planning that we've been talking about for your clients or for yourself. And I think that's a good investment of time. We also have some one-pagers which really focus on a lot of the things that we've spoken about so far in, getting somebody's attention in a short period of time on some of the things like the corporate TFSA, non-limit TFSA, CPP Philanthropy, passive income strategies, and we're very happy to make those available to you. We write for a publication called The Tax Letter that's been around for several decades, and we've been writing since 2011. We have about 70 published articles on a lot of the subjects we talked about today, and we'd love to put you down on our list and have you receive those on a monthly basis when they come out. We also have an estate planning toolkit available at our website, which has the estate directory and the executor's duties checklist and a business owner's succession planning guide. And we'd love to make that available to you as well if you just reach out to Wealth Stewards or to us directly. Next. And that's really it. There's my contact information. We certainly would love the opportunity to help you and help your clients. We really believe that today we're in a period of hyper specialization. I don't think that people can be all things to all people, and specialists have to surround themselves and associate with other specialists. And we certainly would like to be on the team to help you in collaborating with you and your clients. And if we can be of assistance, we would greatly appreciate that and look forward to helping you to save your clients lots of tax and to create lots of goodwill for charities in Canada. And that is the end of it's 1:53. I'd like to open it up at this point in time, Shelby, that hopefully there'll be some people if they have any questions, and if not, I know that this presentation is going to be available online for clients of Wealth Stewards.
Yes, so we do have a couple questions just to end off. And thank you, Mark, very much for your presentation. Very informative. To start off, you mentioned in the CPP Philanthropy section that there was an example of a couple who had a RIF of $2 million. Is there a minimum amount that you would need to have in a RIF to make this strategy successful?
The CPP Philanthropy was for receiving Canada pension plan, right?
Yes,
so
that's correct.
That CPP is receiving Canada pension plan. That's taxable to everyone. It doesn't matter how rich you are. It's the OAS, the old age security that gets called back. And again, if somebody's been contributing, it's about $26,000 to, as I said, a 65-year-old couple. But let's say it's just one person, and they're receiving just their $13,000 as, I have lots of clients who do it. Let's say they only want to use $5,000 of the $13,000 and they're single. There are ways to scale it to make it work for you where you're not necessarily giving it all. It's not an all or nothing situation.
Okay, thank you very much.
I hope that answers the question. If it doesn't, then I'm happy to elaborate further if that wasn't the question they were asking.
No, I think that answers the question. Thank you very much. In regards to the donor advised funds, you talked about that as well. What are the steps to set that up?
Yeah, so the first thing is depending on where they live, like I said, there's a donor advised fund, Barrie Foundation, Oakville Foundation, Kingston, Vancouver. We're very happy to introduce anyone to their local foundation representative, or if they just contact the place directly and explain that they'd like to get more information. They're really very knowledgeable and very helpful to help you understand how it works. If they're not, to meet, we can set up a further WebEx or a GoToMeeting and have somebody from the foundation actually online with us, and we can sort of walk through that together. So that might be something that Wealth Stewards might be interested in pursuing if there's an interest. But I always find that there's what and then there's the people that I always think it works much nicer when you get somebody to make a connection to the right person at the foundation. And the other thing is those foundations have wonderful networking. So, if you set up a donor advised fund, you have no obligation, but they've got all these programs for people who have got a donor advised fund. It could be for kids as well, to teach kids about, investing, and teach kids about planning and legacies and charity. And it's a wonderful, just like you have a yacht club and you've got the golf club and you've got the curling club, there's actually philanthropy associations or communities as well. I find that it's a great way to really get involved, and we'd be very happy to set that up for anybody who contacts us.
Great, thank you very much. Just one final question. What's the most unique way that you've structured insurance to look after capital gains tax in the sale of a business?
In the sale of a business, again, the double dip, as I mentioned, that's actually, I call it a quadruple dip. What it is let's say somebody has they sell their business for $10 million, and again, they've used the lifetime capital gains exemption for one of them, right? So on a $10 million sale, there's going to be, let's say, a $2.5 million tax minus the $830,000 capital gains deduction now. So you're still looking at, $1.5 million, let's just say, or $1.5 million. So if they were to go ahead and take the proceeds, some of the proceeds that they have, and donate those proceeds, remember, all they need to do is donate $1.5 million, because that's the tax, to the charity or to a donor advised fund. They're going to get a receipt for 1.5, but because it's a corporate donation, they get to deduct the full amount. So that 1.5 would reduce their costs of their company, but they would actually now take care of the taxes as well. But the problem is that their family is still out of pocket the $1.5 million. So that's when they could use the credit to the capital dividend account through the sale of the business, where they can then use those tax savings to purchase a life insurance policy, as an example, for $1.5 million corporately. So at the end of the day, their family gets back the same $1.5 million that they made a donation to charity for. So that would be, again, a bit of what I call like double dipping, but each situation is unique and really requires sitting down and having a conversation and seeing about the actual facts on the ground to see how it can be structured.
Okay, thank you very much, Mark. If there are no other questions, I think that brings us to the end of the webinar. Thank you very much for everybody who's joined us. We'll be sending out PD certificates to those who are online, and our next webinar will be on December 6th. So if you're interested in registering for that, please reach out. Thank you very much, Mark, for your time. We really appreciate having you here, and have a great day.
It's my pleasure. And I wanted to wish everybody a wonderful holiday season. We've got a great time of giving, but it's a wonderful time for family and to really enjoy and take stock of all the important things. I wanted to wish everybody a very, very happy holidays and a happy new year.
Yes, very happy holidays to everybody. All right. Thank you very much.